John Hewison, here we are at the start of another year. Firstly, what were the key takeouts for 2010 and were they in line with expectations?
Well, Danielle, there were a number of takeouts from last year, some negative and some positive. On the positive side, the US economy recovered probably better than most people expected. We saw the US get back into positive territory in terms of GDP growth. And the Dow Jones index increased 14.7%, so it was a very strong performance. We also saw some improvement in the major economies in Europe, particularly Germany, where their market improved 12.5%, as did their GDP growth also improved. Compared to that, the Australian market didn't perform as well as we expected. That we really were looking for a continuation of the growth from 2009, where the market recovered 33.5%. We expected really a 10 to 15% recovery in 2010, but the market remained flat. And I think that was really influenced by a lot of things, by some of the bad news coming out of Europe with sovereign debt problems in Greece and Ireland, and that tended to spook a few people. And then we had political uncertainty here with a minority government and some unknowns like the mining tax and the carbon tax, and all of that uncertainty tends to make people nervous. So I guess in the overall scheme of things, we were pretty disappointed by performance, but by and large not unhappy.
Looking ahead now, what is your outlook for the coming year?
Well, we expect the coming year to be a continuation of an improvement in global economies, and the Australian economy is very strong. We've seen companies deleverage, reducing their borrowings. We've seen acquisitions at opportunistic prices. We've seen share buybacks, so the company shares have really increased in their value. So we're expecting some fairly healthy profit increases by Australian companies this year. Dividend increases. Also the issue of resources stocks, that most large resources companies like BHP and Rio are spending billions on infrastructure improvement, which will increase their output. So again, there's positive signs in a lot of areas of the Australian economy. So that by and large we see the future of this year as being pretty positive. We expect again a 10 to 15% improvement in the index this year.
What about the flood crisis? How will that impact investments this year?
It's very hard to say to what extent the floods will have an impact. They'll certainly have an impact, but in terms of primary production, it's really difficult to gauge. There'll certainly be some offsets in that there's be a lot of money spent on infrastructure. The government's forecasting $5 billion in infrastructure expenditure. So on the other side of that equation is the productivity of contract companies and so on who'll benefit from that work. So the overall, it'll have an impact, no question, but to what extent it'll have an impact is very, very hard to tell.
Can we expect any surprises from the property and interest market?
Certainly the Reserve Bank is holding interest rates steady at the moment. There don't appear to be any pressures on inflation for them to increase. But I think it's generally considered that interest rates will increase from sometime around the middle of the year, and probably there's another 1% increase expected over the next year to 18 months. That's going to have a negative impact on residential real estate, but we're seeing that commercial real estate is starting to show some recovery from what has been a very flat period for the last couple of years. As companies improve their profitability, then the demand for commercial real estate is going to improve also.
So John, what's your final message to clients?
Our final message is probably the message that we preach day in and day out, that it's most important to have a planned strategy, a strategy that's planned specifically to achieve objectives, and to maintain that strategy by rebalancing portfolios. Trying to pick the winners is a difficult thing to do, but if you're rebalancing all of the time, keeping your concentration on fundamental values, and all investments, no matter what they are, will ultimately achieve their fundamental value based on their ability to generate income and the value of their underlying assets. So if we maintain our long-term concentration on those factors, then generally speaking, investors will be successful.
Thanks, John. We'll see you next time.
Thanks, Danielle.